Welcome, my friends. Big companies are filing for bankruptcy left and right, and it's just the beginning. Vice Media headlined a group of 7 major companies that filed for bankruptcy in a recent 48-hour period. The filings have laid bare just how exposed highly indebted firms are in the wake of interest rate hikes. Data from Moody's and S&P Global suggest the pain could just be getting underway, and could last all year. What does it mean for the economy? And what does it mean for the future of the United States? But before we get into all of that, please press the like button and leave us a comment below. We would love to hear from you. Please subscribe and hit the bell icon so that you are notified of upcoming videos when they are released. And before we continue, a word from the sponsor of this video. Today's sponsor is InnerLife.com, creator of the InnerLife STS system. InnerLife STS is a cloud mobile platform for mental health care and its integration with primary medical care. InnerLife STS is designed for assessment, data collection and analytics, documentation, and progress tracking. InnerLife STS creates and composes conceptualized narratives and builds them into professional-grade reports. These reports are designed for use by mental health professionals, primary care physicians, justice system professionals and universities, and include mental health assessment reports, mental health treatment reports, and treatment progress reports. And InnerLife STS uses doctor-selected pseudonames for all patients. So, only the doctor knows the patient identity. Vice Media was a Wall Street darling of the journalism landscape. It had a high-profile documentary series on HBO, and web traffic soared largely thanks to a certain polarizing president who'd just taken office. It was worth $6 billion. Now, Vice, saddled with liabilities of up to $1 billion, has filed for bankruptcy. 6 other large companies filed for bankruptcy within a recent 48-hour span, the most active such period for bankruptcies since 2008. The reason? The Federal Reserve's interest rate hikes, designed to rein in inflation, have laid bare the market's weak hands. My friends, the credit crunch is here, and it's spreading quickly, crippling companies with large, cumbersome debt loads. For those looking to refinance, forget it, it's too late. A look at the other recent bankruptcies from recent days shows why. Exorbitant liabilities, mostly in the form of debt. Of course, a bankruptcy filing is not necessarily a death knell for a company. Bankruptcies typically wipe out stockholders, and give companies an opportunity to restructure their debt and come out the other side with a healthier balance sheet. But the surge in bankruptcy filings clearly demonstrates increasing economic stress. And we are still in the first inning of this bankruptcy trend. Wall Street expects defaults for companies with speculative-grade debt to rise to 4.9% by March 2024, up from 2.9% at the end of the first quarter of 2023, and exceeding the long-term average of 4.1%. Wall Street expects the default rate for junk-rated companies getting to 4% by year-end, more than double the 1.7% figure from the end of 2023. Actually, private company bankruptcies are arguably even more troubling. As of early April, UBS found that private filings were outpacing even the early stages of COVID, when many firms went under. A 4-week moving average of 7.8 registered in late February far exceeded a comparable figure of 4.5 reached in June 2020, the firm found. The chart highlights this comparison between present conditions and early COVID-era times, with the caveat that the same trend isn't being seen in public filings. The financial sector is under extreme duress following the collapse of Silicon Valley Bank, with multiple other institutions following suit in recent weeks. Retailers from Bed Bath & Beyond to David's Bridal have filed for bankruptcy in recent weeks. Envision Healthcare, a medical staffing company backed by KKR, was one of the 6 firms to declare alongside Vice. What this assorted list shows is that no industry is safe from balance sheet bogeys. If a company got too aggressive loading up on debt during the low interest rate era, chances are it will soon be feeling the pain. And the recent bankruptcy of Vice Media is still fresh in everyone's mind. Vice Media is a multinational media company that was founded in 1994 as a Canadian magazine called Voice of Montreal. It has since evolved into a prominent global media brand known for its edgy, alternative, and often controversial content. Vice focuses on producing and distributing news, documentaries, feature films, and other forms of media across various platforms, including television, online, and print. Initially, Vice catered primarily to a countercultural audience, exploring topics and subcultures that were often overlooked or underrepresented by mainstream media. Over time, it expanded its coverage to include a broader range of subjects, such as politics, technology, arts, and entertainment, while maintaining its distinctive style and perspective. Vice gained significant popularity and acclaim for its immersive and engaging storytelling approach, combining investigative journalism, documentary filmmaking, and youth-oriented content. It has established a reputation for its bold and sometimes provocative reporting, tackling sensitive issues and challenging conventional narratives. Beyond its original magazine, Vice has diversified its media offerings, including the creation of various digital platforms, such as Vice.com, Vice News, and Vice Studios. It has also expanded its presence into television with the launch of the Viceland cable channel in partnership with A+E Networks. Over the years, Vice Media has grown into a global media empire, operating in more than 30 countries. It has collaborated with numerous high-profile figures, organizations, and brands, securing investments from major media companies and attracting a substantial online following. However, it's worth noting that Vice has faced criticism and controversy at times, including accusations of promoting sensationalism and cultural appropriation. Nonetheless, it remains a significant player in the media landscape, aiming to provide alternative perspectives and voices that resonate with younger audiences. Once a digital media darling, Vice Media Group on Monday filed for bankruptcy protection after years of financial troubles. A consortium of Vice's lenders, which includes Fortress Investment, Soros Fund Management and Monroe Capital, is looking to acquire the company following the filing. The digital media trailblazer, once valued at $5.7 billion and known for sites including Vice and Motherboard, had been restructuring and cutting jobs across its global news business over recent months. The group set to buy the company will provide $225 million in the form of a credit bid for most of Vice Media's assets, the company announced on Monday, along with significant liabilities. Vice is one of several digital media and technology firms forced to restructure this year amid a sluggish economy and weak advertising market. BuzzFeed last month shuttered its news division and announced substantial layoffs. Launched in Canada in 1994 as a fringe magazine, Vice expanded around the world with youth-focused content and a prominent social media presence. It endured several years of financial troubles, however, as tech giants such as Google and Meta vacuumed up global ad spend. To facilitate its sale, Vice filed for Chapter 11 bankruptcy in the U.S. Bankruptcy Court for the Southern District of New York. If the application is approved, other parties will be able to bid for the company. Credit bids enable creditors to swap secured debt for company assets rather than pay cash. The consortium's bid includes a commitment of $20 million in cash to enable Vice's operations to continue throughout the sale process. It is expected to conclude within 2 to 3 months, the company said. Vice said its various multi-platform media brands including Vice News, Vice TV, Pulse Films, Virtue, Refinery 29 and ID, will continue to operate, while its international entities and Vice TV's joint venture with A&E are not part of the Chapter 11 filing. Vice co-CEOs Bruce Dixon and Josefilo Kwanwala said in a statement that the sale process will strengthen the company and position Vice for long-term growth. We will have new ownership, a simplified capital structure and the ability to operate without the legacy liabilities that have been burdening our business, they added. One of Vice Media's biggest creditors is Hungarian-born American billionaire, George Soros. Soros is widely known for his successful investment strategies and his involvement in political and social causes. Soros made a fortune as a hedge fund manager and is considered one of the most successful investors in history. He founded his own hedge fund, Soros Fund Management, in 1970, which became known for its aggressive and high-risk investment approach. He is known for his support of liberal and progressive causes, including democracy, human rights, and social justice. Soros has funded numerous organizations and initiatives aimed at promoting open societies, democratic governance, and civil rights. Fortress Investment Group LLC is another one of Vice Media's biggest creditors. Fortress Investment is a global investment management firm founded in 1998 by Wesley R. Edens, Rob Kaufman, and Randall Nardone. Fortress operates as a diversified investment company, engaging in various investment strategies across different asset classes. The company initially gained prominence by focusing on alternative investments, particularly in the private equity and hedge fund sectors. It managed funds that invested in distressed assets, real estate, and undervalued companies. Fortress played a significant role in the distressed debt market, acquiring distressed assets and companies at discounted prices and seeking to generate returns through restructuring, turnarounds, or asset sales. Over time, Fortress expanded its investment capabilities and diversified its offerings. It established specialized funds targeting infrastructure, real estate, credit, and other investment opportunities. The firm also entered into the world of permanent capital vehicles, such as real estate investment trusts, REITs, and publicly traded investment funds. In 2007, Fortress made history by becoming the first large private equity firm in the United States to go public, listing its shares on the New York Stock Exchange. This move brought increased visibility and scrutiny to the company and the broader private equity industry. In 2017, SoftBank Group Corp., a Japanese multinational conglomerate, acquired Fortress Investment Group for approximately $3.3 billion. Despite the acquisition, Fortress has continued to operate as an independent entity within the SoftBank umbrella, maintaining its investment strategies and operations. Today, Fortress Investment manages assets on behalf of institutional investors and private clients worldwide. But, what do you think? Please leave us a comment below and hit the like button. We would love to hear from you. Please subscribe and hit the bell icon so that you are notified of upcoming videos when they are released. Please share this video on social media. Thank you for watching.